Nobody can do it like this day trader can. I said, nobody can do it like this day trader can. Haha. Welcome back to the Absolute Boss Collective. I'm your host, Absolute. Duh. Today we're going to be talking about covered calls. That's an option strategy, covered calls. We're going to get into that in a second, but if you're new to the channel, do me a favor, hit that subscribe button. Go ahead and hit the like button and hit that notification bell so you can know when Absolute comes back with brand new content. And without further ado, let's get right into it. Covered calls. Okay. All right, so a covered call is an option strategy whereby you can generate income on positions that you're holding in your portfolio. Okay? Now, this is something that you need to be approved by your broker. So you would fill out an application or something like that, and it's a relatively seamless process. Okay? This is the lowest level or the first level that you would get approved for. So it's relatively easy. Most anyone can do it. Now, if you're holding 100 shares, 100 or more shares of any particular stock, you can sell a covered call against it. And it's a covered call because the position is covered by the 100 shares that you are holding. So it really doesn't matter what stock it is, but let's say you're holding 100 shares of a stock that you paid $10 for. Okay, so that's $1,000 that you spent for this 100 shares of these stocks, of this stock. If you do not think that the price is going to move quickly in the near term, and you plan on holding this for a while, you can go ahead and sell a covered call. Now, let's say you want to sell a covered call, a $15 covered call. Okay, so that will be termed as a strike price. Okay, now what you're doing is called a buy right, or actually it's called writing. You're writing a covered call. So you would write a covered call stating that whichever person wants to purchase whoever buys the call will pay you $15 at some point in the future. That's called the expiration date. And they will pay you $15 for those 100 shares that you have. Okay, you go ahead and sell that. What you collect is called a premium. So what they're paying for the right to buy your shares is called a premium. They may pay, let's say, $2 per share for that. That's going to be $2 per share times 100, and that's going to be $200 that you would receive into your account. Okay, now let's fast forward to the date that you selected when you wrote this covered call contract. If the stock, or it's sometimes called the underlying, so if the underlying security or stock that you're holding does not reach that price of $15, then you will go ahead and keep the premium that the person paid, and you will keep your 100 shares. Okay, that's the good side. The bad side, it's not necessarily a bad side, but on the other hand, if the stock, let's say the stock went from $10 to $20 within this time frame that you wrote this contract for, you would get $1,500, right? Because you sold a $15 strike for those shares. So you would get $1,500 for your shares. You'd get the $2 that you received as option premium, so you get $1,700. But now your profit has been capped because you sold that covered call. Okay, so all of that price appreciation from $15 to $20, you lose. You sold your right for that. Does that make sense? If it doesn't, leave me a comment and I can clarify that. Okay, it's a very popular strategy. Okay, it's used to generate income because, as I told you, if the underlying or stock that you're holding does not reach that strike price by the time the expiration comes around, you keep that premium and you keep your shares. And guess what? You can turn right around and do it again. Okay, you can sell, depending upon which underlying stock you're using, you can sell week to week covered calls. You can just continuously do this. Okay, you can sell monthly covered calls. You can even sell a yearly covered call. Okay, some of the issues you may get into is pretty much that same issue, that if the underlying stock rises higher than what you sold the strike at, you lose that upside potential. Okay, another negative aspect of it is you're holding the stock, and if you, let's say this hypothetical, we did $10, right? So if your stock drops, you're going to, let's say it drops $2, now it's $8, you're down $200. Okay, you're kind of locked into that position because you sold that contract. Now, of course, you can always buy it back. You can buy it back at any time. So if the stock price drops, the price that you sold it for will decrease as well, and you'd be able to buy it back, for cheaper than you sold it. And again, you can continuously do it over and over and over again. The only thing is, if your position is tanking, you know what I'm saying, then you're going to be losing that money. You're going to be holding on to a loser. But you can mitigate or limit the loss because you're selling the covered calls on a week-to-week basis or a month-to-month basis, whatever. So you're getting that premium in, which is going to lower your cost basis. In our example, we said $10. So if you're selling it from week to week, whatever you're receiving in premium, okay, is in a sense lowering your cost basis. You can buy more shares with that premium. You can use that premium to do anything that you desire with, but in an aspect of it, you are lowering your cost basis. Okay, let's see. I wanted to talk a little bit about my covered call Blunder, and this was dealing with Mara, M-A-R-A. So this stock, I've been trading it for about 3 months, 4 months. It's tied to Bitcoin, so when Bitcoin rallies, typically it will rally as well. I've made upwards of $3,000, $4,000 off of it during that time frame. And I've also been selling covered calls, and that's something that I've just been flipping. So I'll sell the covered call. If the stock pulls back and the premium on the covered call decreases, I buy it back and I resell it. I did this about 19 times. One of those times that I did it, I sold it for $400, and the stock just took off like crazy. This was in early January. The stock took off like crazy, and I wound up buying it back just because I think I was expecting Bitcoin to hit 60,000 or something like that, and I didn't want to be obligated to provide those shares at a low price, a lower price than what I wanted, so I had to buy that back. So it cost me about I bought it back. I lost about $400, $500 on that trade because I had to buy it back because the price appreciated, I'm going to put in some examples here. And share with you is going to be GameStop. Now, GameStop is, going crazy again right now. There's a whole lot of anticipation of these changes for an e-commerce move. So it's been rocking and rolling somewhat, even though, we're kind of feeling it in the market right now. The market is taking it on the chin. Bond yields have spiked. Tech is getting crushed. And in light of all of that, we have a lot of volatility out there, which leads me to my next point, that volatility does play a part in the covered calls. So if you take something like GameStop, which is going to come in right about now. Now, as you can see, in the area that I highlighted, the volatility is so high that there is some juicy premium that you would receive if you were holding 100 shares of GameStop. Okay, so that premium you would receive. Okay, I have another one that I'm going to put as a lower price stock, and you'll see it's a lower volatility, and there's a lower amount of premium you would receive. However, it's still free money. So if you're holding 100 shares of anything out there, check and see if it is an optionable stock, if there's options available on it, and if so, consider selling covered calls. I mean, I'm not your financial advisor. I'm just a day trader, and I'm sharing my knowledge with all of you guys out there, just to try to help you guys get to where I am. This is the Absolute Boss Collective. Well, we try to get bosses out here, and one of the ways that you can get bosses is by learning these markets and mastering these markets and trading. You know what I'm saying? So volatility definitely plays a part in the premium that you will receive. It's something worth considering if you're out there and you have positions in your portfolio. You have 100 shares or more, just consider selling them. Because if not, you're just leaving money on the table. Okay? The only thing that I would say, which is the best tip that I can give you, this is the trick. All right? Listen up, kids. This is what you do. When you sell the covered call, you are selling the covered call for a price that you do not expect it to hit by that expiration date. Okay? So if you're selling it at a price that you and I know that it's not going to hit by the time the expiration, then that's just free money. You understand? You could also sell it in the money, which means in the money just means, if the stock is $10, you're selling an $8 cover call or a $9 cover call, or a $10 cover call will be at the money. An $8 cover call will be in the money, and that's deep in the money by $2. Okay, so if you're confused about any of these terms that I'm using, in the money, at the money, out of the money, strike price, just leave a comment down below, and I will answer that for you. Quick, fast, in a hurry. I might need to do another video. I'm going to start talking a lot more about options, because options, the thing about options is it's leverage. Okay, and leverage allows you to use way more buying power than your capital. Okay, so let's see. This is pretty much everything there. Okay, yeah, I think we covered it all. All right, so If you're new to the channel, consider subscribing. Okay, hit that like button. If you need to open an account, I have 2 links below. I have one for Webull, one for Robinhood. Go ahead and consider signing up that way. Okay, if you want to support the movement, you can check the guard out on Patreon. Hit me up over there. And this is Absolute signing out for the Absolute Boss Collective. Peace.